Welcome everyone to this week's Mortgage Minute by MortgageWorks. My name is Art Alvarez with MortgageWorks, where we do have the answers and they're on the house. So I want to jump right into things because, as you know, we always start with a rate update and a market update in terms of the bond market. Here's our current rate grid. I've updated it today to reflect some improvement in mortgage rates. We've actually gotten a decent amount of improvement in general. When you look at these rates on the grid, we're about 0.25% or more better than where we were a week ago. And this can be sort of underscored when Jeff pulls up the chart, the 5-day chart for the 10-year bond yield, which, as you know, if you've been watching the show, that's my favorite barometer or benchmark to check on every day to kind of get a trend of where mortgage rates are going. And this is the kind of graph we like to see. You can see a week ago, last Friday, the 10-year yield was basically approaching 490. Earlier this week, like on Wednesday, it actually got up, pretty good above 490. But then you see that big drop off going into today, and of course down to 4.66. So that's really good news. And as a consequence, mortgage rates have followed in a similar fashion downward in the same direction. And that's why I say mortgage rates in general, depending on the product, are about 1/4, even 3/8 better than where they were a week ago. So that's good news. And in terms of the details of why this kind of movement has happened, there's a few things. Number one, this week was a very crowded week for economic calendar data points, in particular from mid to end of week. Some of the items coming up this week included the Fed met this week, the Federal Reserve Board. ISM Manufacturing, that's Institute of Supply Manufacturing, Institute of Supply Management Manufacturing Index. And then, of course, there's JOLT, job opening labor turnover, and then employment numbers. Now, there's even more data points that are being released this week, but these are kind of the major ones. For the JOLT report, for example, last month, for the forecast for October was 9.4 million job openings. Actually, the actual number came out at 9.6. So that's an indication that businesses are hiring, which tends to be a data point that's showing some strengthening of the economy. Of course, there's ADP, which I've told you before, I don't like ADP in terms of their forecast of new job openings. There's initial claims for unemployment and the unemployment rate, which actually comes out on Friday. In terms of the initial claims for unemployment, that comes out on Friday too, and it's forecast to increase to about 217,000 from 210,000 last week. So if that were to be true, that would be a kind of a cross current of showing maybe the economy is weakening a little bit. ISM Manufacturing was forecast to be 49.2, up from 49 in September, but in reality, it dropped to about 46.7. That's a sign of weakening. So again, we've got some cross currents here. But the big change in the market that's really affected the bond market in a positive fashion, as well as mortgage rates, is the Fed decision on the Fed funds rate this week. They had their meeting this week, concluded yesterday. And then, of course, after the meeting, the Fed has their press conference where Chairman Powell discusses the outcome of their meeting and their decision. Their decision was to leave the Fed funds rate unchanged. So the pause continues. And as a consequence, and further, while Powell did indicate there's still possibilities of increases on the table in the future, what's happening now is the financial markets, the bond market, they're reading into this that it looks very, very likely that the Fed may pause here and not go any higher. So that's really given some positive news to the markets. The stock market's way up today. And then, of course, you saw the bond yields coming down quite a bit from where they were earlier this week and certainly last week when we were teasing at the 5% level. So, cautiously good news. Hopefully this is going to maintain itself. I think it's going to. There's less and less signs that the Fed's going to keep raising rates. I think the effect of raising rates has already taken to effect. Just because of market rates in general, particularly in the housing market, already being at those elevated levels. I think that's accomplishing what the Fed was trying to accomplish.